Hi, this is Adam Khoo, and in this video, I'm going to show you how you can use stock options to profit in any market situation. So whether you are a long-term investor, value investor, or you're a short-term trader, whether you're trading stocks or trading Forex, learning how to use options will give you that additional edge in the markets to allow you to lower your risk and to maximize your returns on investments. So if you're a complete beginner, this video will help you to really use options in a very powerful way. So if you've got no idea what options are, here's a quick lesson. Basically, there are two kinds of options. You have got call options and put options. So what's an option? When you buy an option, you're buying a contract between you and the person who sold you that option, who could be anyone out there, you don't really care. Okay. So when you buy a call option, you now have the right. Buying an option, a call option gives you the right. You have the right, but not the obligation, right? But you have the right to buy 100 shares of a particular stock. So again, it could be Amazon, Apple, Facebook, right? And you can buy 100 shares of this stock at a price that you lock in. And that is known as the predetermined strike price. So no matter where the stock price goes, you have the right to call the shares at the price you have locked in before or on an expiration date. So how could you use this powerful tool? So here's an example. Let's imagine you're looking at Apple, and Apple is currently selling at $155, and it's the 29th of January, for example. And you think Apple shares are going to increase in price. You're bullish on Apple because it's on an uptrend, it's a great company. What could you do? Well, first thing could be simply buy the shares. That's what most people do. So if you buy the shares, it's going to cost you $155 per share. So if you were to buy 100 shares, it's going to cost you $15,500. So that's a huge investment for most people. Now, if the share price rises to $180, your shares are now worth 180 times 100. They are now worth 18 grand. If you sell the shares, how much do you make? You make 18 grand minus 15,500. You make $2,500 in profit. Not bad for about 3 months, right? So 2,500 out of the 15,500 of investment capital. That's a return on investment ROI of 16% in about 3 months. Again, that's not too bad. Now, if you knew how to use options, you could actually boost your return on investment, at the same time lower your initial risk and your initial capital. So most people think, I don't have much capital, I can't buy high price stocks. Options allow you to do that. So let's take a look at how we would use options. So at $155, instead of buying the shares, you could buy a call option on Apple shares. You buy the Apple call options. So for example, you buy the Apple March 155 call options. So what does that mean? Basically, you are now buying a contract, the call option that gives you the right. You have the right to buy Apple shares at $155. You've locked in the price at 155. Again, we call that the strike price. So no matter where Apple share goes to, Apple shares can go to $1,000, but you still have the right to buy it at $155. But you must do it before the expiration date in March. And options expire on the third Friday of the month. So the third Friday of March, it expires. Anytime before that, you can call the shares at 155. Of course, nothing is free in life. In order to have this special right, you have to pay a premium, a price to buy the option. So in this case, it's about $6.20. Usually, if you buy a call option where the strike price you're locking in is near the market price, you're paying about 4% of the value of the share. So 4% of about 155 is about $6.20. Now, each contract is 100 shares. So with the call option, what's your investment capital right now? So you're buying the call options at $6.20, correct? And again, you have to buy 100 shares. That's the minimum per contract. So your total investment is now $620. So off the bat, by using call options, what happens? Instead of requiring $15,500 to buy 100 shares, you only require $620. So options are perfect for people with small capital, but they like to take on bigger positions or buy high price shares. So in this case, what happens? So again, the stock price rises to 180, like in the first scenario. So the stock price goes to 180, but you have the right to buy it at 155. So if you were to exercise your right, we call it you exercise your options, which means you buy the shares at 155 and sell it at 180, what would the profit be? The profit would be 180 minus 155. That would be a profit of $25. So because of that, your call options now have an intrinsic value. They are now worth at least $25. So instead of actually buying the shares, what you could do is to sell that call option at the higher value it is now worth. Recall, you initially bought the call option at $6.20. But now the call option is worth at least $25 because of its intrinsic value. So what would your profit be? So you sell it at $25 when you bought it at $6.20. That gives you a profit of $18.80 per share option. So again, times 100, your profit from selling your call options would be 1,880. So in this scenario, you made $1,880. You may say, hey, isn't it less than 2005? Yeah, it's a bit less, but this time you only required $620 in capital. So if you take 1,880 divided by 620, your return on investment is now 203%. So again, off the bat, by using a call option, what happens? You get a much higher return on your capital compared to buying the shares itself, and you require less capital. So there are altogether 7 ways that options are going to help you to become a more effective investor and a trader. The first 2 reasons we talked about, right? So number 1, with options, we can control high price stocks with small amounts of capital. And number 2, we boost our percentage return on investments. Let's take a look at another very quick example. So you're looking at Intel, for example, and Intel is on a downtrend here, and it goes sideways in a consolidation, and now you can see it's changing trend. It's reversing into an uptrend, and it's trading at $53.26. So you think it's going to continue going up back to the previous high of at least 57.60, somewhere about there. So again, what could you do? You could buy the shares and pay a huge amount of money, or buy the call option to lock in the price at $53. So let's see how that works again. So in this case, we will take a look at what is known as the option chain. In the option chain, we can see all the different options that we can buy at different strike prices at different dates to expiry. You choose the option that you want. So this is the option chain on Intel. And again, you can see these are the call options. And these are the different strike prices. So you could lock in the price at 52.50, 53, 53.5, choose the strike price that you like. And of course, you can choose the date to expiration. You could choose an option that expires in a month, in 2 months, in 3 years, or in 5 days. It's up to you. Of course, the longer the expiration date, the more expensive the option will be, the higher the premium. So in this case, you choose the option that has 27 days left to expiration, that expires on the 18th of April. So it's the April call option, and we're choosing a strike price of $53. And again, what does that mean? That means that we now lock in the price at $53. We have the right to call the shares at $53 no matter where the share price goes to by the end of April. So how much does it cost to buy this option? So you can see over here, the market price of that particular option is $1.49. So it costs us $1.49. Now again, you have to multiply that by 100 shares per contract. So that's $149. That's all it takes to control 100 shares of Intel. So if we buy that option, let's take a look. It will cost us 149 times 100, again, $149. So once again, with $149, we control $5,326 worth of Intel shares. And again, if you're wondering, how do we get that figure? It is 53.26, the current price times 100 shares. There you go. And again, with this option, we have locked in the price at $53. So if Intel goes from 53.26 to 57.60, that's an 8% increase in the price. Now, if you were to buy the shares itself, your return on investment would be 8%, but not in this case because we are using the call options. So again, our total cost is 149. We've mentioned that earlier. So if Intel increases to 57.60, what happens now? Remember, you have the right to buy it at $55, but now it's at 57.60. So you could exercise your right, buy it at 55, sell it at 57.60, and make a profit of $4.60 per share. And that means that your call options are worth at least $4.60. We call that the intrinsic value of the call option. Now, in reality, they're going to be worth more because there's what is known as time value, but more on that later on. Okay, so you bought the call options at 149, right? And now your call options are worth $4.60. So if you sell your call options, what's your profit? 460 minus 149, you make a profit of $3.11 per option share. So times 100, that's $311. You made $311 in profit out of $149 of initial capital. So again, 311 divided by 149 gives you a return on investment of 208%. So you can see that an 8% increase in the share price leads to a 200% increase in your capital because of the lower capital required. So again, options increase your percentage return on investment, at the same time requires much less capital. Alright, so the third reason to use options is because options allow you to limit your risk, at the same time have unlimited returns. See, some people have this misconception that options are risky. Absolutely not. In fact, if you know how to use options the right way, options are less risky than buying the shares at times. Now, when I talk about options, I'm not talking about binary options. If you ever hear the word binary options, please run away, because binary options, most of them are scams and they are structured to make the buyer lose money. So these are not binary options. These are legitimate stock options that professionals use, that I use, okay? So let's again see how options limit your risk, at the same time allow you to have maximum returns. Now, when you buy the shares of a stock, you have both high risk and high return, because if the stock price goes up, you make money. Stock price drops, you lose money as well. So in the previous scenario, if you were to buy 100 shares of Intel, what does the profit and loss graph look like? It looks like a straight line, like that, okay? Now, on the y-axis, we have got profit and we've got loss. And that's the break-even zero line. So anything above that's profit, below that's a loss. On the x-axis, we have got the share price, as you can see over here. So if you were to buy Intel shares at 53.26, that's your entry price, correct? Okay, so if Intel shares increase by $4.34 in this case, what happens? Right? Share price increases, you make a profit of 434 because you multiply by 100 shares. This assumes you buy 100 shares. At the same time, if Intel shares fall, what happens? That's right, you will make a loss. So you can see that when the share price goes up, you make a profit. Share price goes down, you make a loss. Now, what's the risk of buying the shares itself? Well, the risk is this. If the company goes bankrupt, now of course it's unlikely, but if the company goes bankrupt and the shares drop to zero, what happens? That's right, you can lose your total investment, which is you lose 53.26 times 100 shares, you lose $5,326. So that's the risk of buying the shares itself. If the shares go to zero, you lose everything, huge amount. On the other hand, when you buy a call option, what happens? It's no longer a straight line. It becomes like a Nike sign, right? There you go, there's a Nike sign, right? So this time with a call option, you've got the same unlimited return. If the share price goes to the moon, you can make unlimited profit. But this time, your risk is capped. Your risk is capped at the price you pay for the options. So in the case of Intel, we bought it at $1.49. Times 100, that's $149. So what does that mean? That means even if Intel goes to zero, the very most you can lose is $149. You can't lose more than the price you paid for the options. So we've got limited risk, correct? But at the same time, if Intel shares go to $57.60, you make $311. If Intel shares go to the moon, right, you make unlimited profit. So again, options allow you to achieve unlimited return with limited risk. Now, of course, when you buy the shares of a stock, you could always place a stop loss to limit your losses. And I do that as well. And that works most of the time under normal circumstances. But sometimes shit happens. And when something bad happens to the company, like, it announces bad earnings, or like, Boeing had a plane crash or some stuff like that, the price can gap down way below your stop loss. And when the price gaps down, your stop loss can't save you. You will end up selling at a much lower price than your intended stop loss price. For example, this stock, Biogen, was trading at $340. All right. And imagine if you had bought it at $340 and you placed a stop loss at $300, and you said, okay, I'm only prepared to lose $40. If the price goes down and hits my stop loss, I'm out. But the trouble was, the company announced really bad news. Their cancer drug kind of failed one of the tests, and the price gapped down to $230 overnight. So when that happens, you don't get to sell at $300. You get to sell at the opening price of the market, which is $230, which means you were prepared to lose $40 per share, but you end up losing $110. So that's when shit happens, okay? So with an option, that can never happen, because when you buy the option, you're paying the premium. The most you can lose is that premium, even if the stock goes to zero. Now, this is really useful when you're playing on stock earnings, right? So companies announce earnings every 3 months. And when they announce good earnings, the price can gap up and you could make a lot of money. In fact, one of the strategies that we use, we play with stock earnings. So in this case, Netflix, from $100, announced great earnings, it gapped up to $116. So if you had bought the shares before that, or bought the call option, you make a small fortune. But the risk of playing earnings is it could gap down and then you are screwed, right? So the safest way to play with stock earnings is not to buy the shares itself, but it's to buy the call option. So when you buy the call option and it gaps down, what happens? You just lose your premium, which is again $3 or $4, and that's it. But if it gaps up, you could make a few hundred, a few $1,000s. And that's when options are really useful, when you want to minimize your risk and maximize your returns in these scenarios. All right, reason number 4, options allow us to profit in any price direction. So with options, we can profit whether the stock price goes up or the stock price collapses. Let's take a quick look. So to do that, you have to now learn put options. So we had call options, calling is buying, put options would be when you put, you sell, right? So what's a put option? When you buy a put option, once again, you're buying a contract from a seller of the option. Whoever it is, we don't really care, okay? So as the buyer of the put option, you now have the right, not the obligation, but you have the right to sell 100 shares of a particular stock, like GE or Amazon or Twitter, whatever it is, at a predetermined price that you have locked in. We call that, again, the strike price. And you can do so anytime on or before an expiration date. So how can you use put options? Well, you can use it, or you can use these options to profit when you expect the price to go down. So let's take a quick look. So imagine you're looking at GE, one of the worst performing stocks right now, and it's on a very, very clear downtrend. From the moving averages, you can tell. So on the 22nd of October, GE was selling at $12, and you think it's going to go lower because it's a downtrend and it's losing money. Okay, so what could you do? Well, you could lock in the price to sell GE shares at $12 by buying a put option. So you buy the GE November 12th put option. So again, what does this mean? This means that you have the right to sell GE shares at the strike price of $12. That's the strike price, the price you've locked in, and you can sell GE shares at $12 anytime before the expiration date, which is November, the third week of November. So even if GE shares go to zero, you can still sell it at $12. Again, to have this right, you have to pay a price for the options. We call that a premium. In this case, it costs 48 cents. That's all. Okay. So the minimum contract size would be 48 cents times 100 shares. So one contract is 100 shares. That will cost you $48 for a contract. So you can see that with options, you can use very little money to make huge profits. Okay, so that's the capital you require. So in this case, you were right, and GE shares fall from $12 to $8.30. Stock falls to $8.30. But guess what? You have the right to sell the shares at $12, but they're now at $8.30. So technically, you could borrow the shares, sell it at $12, we call that short selling, and buy it back at $8.30, making a profit of $3.70. Because $12 minus $8.30 is $3.70, which means your put options are now worth at least $3.70. We call that the intrinsic value of the put options. Now, you don't actually physically get the shares and sell the shares, right? You just have to sell the options at the higher price where they are right now. So again, you bought the options at 48 cents, and now they are worth $3.70. So you sell it for a profit of $3.22 times 100. That's $322 in profit. So you just made $322. Divide that by $48, which is your initial capital. Your return on investment is 670%. So again, you can make huge returns with minimum risk. Now, again, if they did not go down and the share price went up, how much would you have lost? You would have only lost $48. That's the maximum risk. So again, you can see options are very low risk and very high returns if you use them correctly. So if you think the price of the stock is going up, you buy a call option to profit. If you think the price of the stock is going down, you buy a put option to profit. Now, what if you've got no idea where the stock or the market is going, but you know it's going somewhere? Well, you can use a strategy known as a straddle. So here's how it works. So this is the S&P 500 ETF, the SPY, and over here you can see that it's on a very strong uptrend. So you think that it's going to go up, and it's currently at $279. But at the same time, you see a strong level of resistance over here, and you think, hey, it may not break that resistance and it could come all the way back down. So you've got no idea where it's going. Have you ever been in this situation? So what could you do? Well, you could bet on both directions at the same time. So right now, the price of the ETF is $279. So what you do is you buy a call option with a strike price of $279, and at the same time you buy a put option with the same strike price of $279, which means you lock in the price to buy and to sell at $279. So if it goes to the moon, you can buy at $279. If it drops to the floor, you can sell at $279. So what happens when you do that? You get a profit and loss graph that looks like this. And that's the great thing about the charting software. It will show you your profit and loss at different prices. So again, on the y-axis, we've got your profit is $5,000, 4 grand, 3 grand. Okay, so that's a zero line. Anything above that is profit. And of course, below that, you make a loss. And on the x-axis, you've got the stock price or the price of the ETF. So currently the price is $279, right? Just below 280. So again, what happens? If the price shoots up, the price goes up to 290 or 300, what happens? That's right, you make a profit, right? You make a profit of, $1,000 or, $2,000 if it goes all the way up. But if the price collapses, right, the price drops to 270 or 250, what happens? Or 260, you can see that you make a profit as well of $1,000. So you make a profit in either direction. Now, of course, there's always a catch. What's the catch? The catch is if the price doesn't move at all and stays there at the center within 270 to 290, what happens? That's right. Your call options and put options will expire worthless and you would lose the premium. But again, you're betting a small premium on a large profit if it moves in either direction. And that's the beauty of options. It's extremely flexible. Now, investors use put options to protect their investment portfolio as well. So put options are exactly like insurance policies that you buy. So for example, you've got a house and there's a wildfire. You think the fire is going to reach your house. What do? You buy fire insurance. You pay a premium to protect the value of your house for a year or 3 months or whatever it may be, right? And what happens is if your house burns down, you collect on the insurance policy. The insurance company will pay you the full value of your house. Now, wouldn't that be cool to use that in the stock market? Well, we use it all the time. We call those put options that we use to protect our investment portfolio. So let's take a look at how this can be done. So let's imagine you bought P&G stock at $86 and you bought 100 shares, so you've got an investment of $8,600. In a couple of months, the share goes all the way up to $104.66. So now your shares are worth $10,466. You're pretty happy. So you're sitting on unrealized profits of 1,866. Basically, it's 10,466 minus 8,006. Now, why are these unrealized profits? Because you have not locked in the sale. If the price happens to drop all the way back down, your profits would disappear. So for most investors or most traders, if they want to lock in the price, they would simply sell the shares at 104. The trouble is once you sell the shares, you're out of the stock. If the price continues to rise, you don't get any more potential upside. So is there a way for us to lock in the sales price? Lock in our sales price at 104. At the same time, we can still benefit if the price continues rising. The answer is yes, using put options. So again, a put option is kind of like an insurance policy that you buy where you can insure your stock for a certain value or price. So in this case, we like to buy a put option with a strike price of 104. So in this case, we like to buy a put option with a strike price of 104, which means we have the right to sell the shares at 104, no matter where the share price drops to. So how much would it cost to buy this put option? So looking at the option chain, this is again P&G, this is the option chain, and we're looking at puts. And again, we can choose whatever strike price we want to lock in our sales price. So in this case, we choose the strike price of 104. And how much does this cost? It costs the market price of $2.38. Again, this is per option. We have to buy a minimum of 100 options in a contract. So times 100, you get $238. So that's what it costs to insure our stock. So let's take a look at how this works. So basically, with these P&G 104 puts, again, what this means is we are buying the put option with a strike price of 104. That gives us the right to sell the shares at 104 anytime before the expiry date, which is the third Friday of May. And again, we've paid $238 for this. So in other words, $238 insures $10,466 worth of stock. Again, this is kind of like your house value. This is the fire insurance that you pay to insure the value of your house. So if your house burns all the way down because of a wildfire, because of a market crash, no worries, you get paid $10,466 because of your insurance that you pay. Now, what if the stock doesn't crash? What if the stock from 104 goes all the way to $200? Okay, then this put option that you bought would expire worthless and you would lose your $238. But would you be upset? Of course not. It's kind of like you buy fire insurance on your house and your house doesn't burn down. You don't get upset. Say, why did my house burn down? Now I had to pay the insurance for nothing. You don't do that. You're okay because the house value goes up, you get richer. And the insurance premium you paid was a small cost of protecting your house. So this was a small cost of protecting yourself while you allow for upside gains. And that's the beauty of using put options as insurance contracts. Alright, so the next reason to use options is one of my favorite, is to generate income from your investments even if they go sideways. Have you experienced a time when you bought the stock of a great company? You knew in the long term the stock price would increase, but in the meantime, for a few weeks or months or a year, it's kind of like drifting sideways and you're sucking your thumb, not making any money. Well, with options, you can make an additional 15 to 20% return on a stock that's moving sideways or even down for a period of time. Let's take a look at how this can be done. So usually when you invest in a stock, there are two ways of making money. The first way is known as capital gain, which means the increase in the price, and the second method is collecting dividends. Now, the trouble is a stock price doesn't go up in a straight line. Sometimes it can go sideways for weeks or months or even years. And for most investors, those times are opportunity costs where they don't make money. I'm going to show you a way of how you make money during those times as well. And the way to do it is by selling call options and collecting premium. So now you've got three streams of income: capital gain from the price, dividends, as well as collecting premiums by selling call options. So all this leads to a higher return on investment in your portfolio, an additional 15 to 20% return on top of your capital gain and your dividends. And that's how I'm able to generate up to 50 to 60% return on my investment portfolio almost every single year. And you can watch this on my monthly video updates on YouTube. So let's take a look at an example of how this works. So once again, let's imagine you hold shares in a fundamentally good company like Coca-Cola. So in the long run, you are confident it will rise in value. You can see on the left, this is the long-term chart of Coca-Cola. It's the 10-year chart, and can see the long run, Coke shares always go up. But in the short term, which is the right-hand chart, the stock price seems to be going sideways, down, or moving up very slowly. So you can see that the price was going up and it's facing some resistance at $50.50. So it's kind of like going sideways, looks like it's going down. It looks like it won't be going up very much in the next few weeks or few months. So what do? How do you make money when it does that? Well, you can sell out of the money call options to collect premium. So let me explain how that works. So previously we learned to buy call options. By buying a call option, we pay a premium, and that gives us the right to buy the shares at the strike price. We're now doing the complete opposite of that. We're now selling the call options. So by selling the call options, we are collecting premium. In this case, we are selling the Coca-Cola call options at a strike price of $51, and we collect the premium of $1.50. So that's income for us. Now, by selling these call options, what happens? We are obligated to sell the shares at $51. But that's fine because the shares are now at $50. So if it goes to $51 and we sell it, why not? We make a profit anyway if it goes up. If it doesn't go up, we collect the $1.50 in extra premium. Now you may be thinking, what is $1.50? Well, $1.50 out of $50 is about 3%. and you sell the call options that expire in about 30 to 45 days, which means in 30 to 45 days, the option expires and you're no longer obligated, but you collected the $1.50 of free money in a sense. So you made 3% in 30 days. Now, if you do this every month and you multiply that by, say, just 10 months, not even 12 months, that's an additional 30% return on your investment portfolio. So again, to be conservative, I'm not even talking about 30%. If you were to just do this for 8 or 9 months, you're making an additional 15 to 20% return a year on your investments, even if the price goes sideways. So I believe you can now see how simple and powerful options are, how they can help you to generate additional income, increase your return on investment, and lower your costs and risk as an investor, as a trader. And what you've learned so far is just less than 5% of what you can learn. So if you want to learn more on exactly how to implement this and live examples and my hand holding to show you exactly how it's done, go on to piranhaprofits.com, where I've just launched my professional options trading course, and you get the pre-launch price, which is 60% off the retail price, and it's expiring on the 30th of April. So, as of now, as I'm making this video, it's about 5 days left. So if you want to grab this offer, go to Piranha Profits and grab it while it lasts. So what do you get in this course? The first thing is you get lifetime access. I'm a believer in lifetime access in all my programs. I don't believe in subscriptions that course expires. I believe that once you purchase something, you should have access for it for the rest of your life and get all the free updates that go along with it. You get 9 complete lessons of content on video. That's about 803 hours. That's almost 14 hours of learning and training of content. And it also includes a lot of live trading examples of how do we actually execute these trades, how do we exit the trades, how do we look for these trades every single day. You get the proprietary trading tools that we use to scan the market for stocks, to write options on, to buy options on. You get dedicated email support answering all your questions, so you're crystal clear on how to implement this. So this is especially for those of you who want a simple, easy to understand way to use options in your investments and trading. And you get a special enrollment bonus as well, our quick reference guide to get you started immediately. So what do we cover in these 9 lessons? Well, in lesson 1, you're going to learn the basics of options trading. And again, I won't go through the detail. You can read this all on our website at Piranha Profits. In lesson 2, you learn how to set up your charting software and trading tools. So we teach you exactly how to use the tools and software that we've been using to use the right option strategies. Lesson 3, how do you buy calls, how do you buy puts? And again, it goes through all the details on how you execute the trades, a lot of live trading examples. Lesson 4, on how to generate additional income selling covered calls. And lesson 5, how do you hedge your portfolio by buying insurance, protective puts. Lesson 6, you'll be learning how to buy stocks at huge discounts or even for free using a strategy known as selling cash secured puts. It's one of the strategies used by Warren Buffett. In case you don't know, Warren Buffett is the biggest user of options trading in the world. He trades billions of worth of options every single year. In lesson 7, you'll be learning an advanced strategy known as the vertical call spread and the vertical put spread in lesson 8. In lesson 9, you'll be learning how to use technical analysis to read the market. Is the market going up? Is it going down? Is it going sideways? So you know exactly which option strategy to implement with your investment or trading portfolio. So again, hop on to piranhaprofits.com. You can read more about the curriculum and content over there, our student testimonials, and again, you've got to the 30th of April to grab 60% off this course. So run over there right now and find out more and enroll, and I'll see you guys in the program.